So I guarantee you, I called Amy before I prepared my material for this and said, can I do this, all right? Because I did not want to get roasted up here because, people think I'm taking political sides, which I guarantee you I will not, all right? Now, first of all, I am absolutely honored to be here. I'm honored every year to be here in front of you, everyone. It's a wonderful group to speak to and to meet people I've known for the last 30 years of my life. And Amy mentioned Howard, and in our family, Kay and I cannot tell you how many times Kay or I will say, "What's time to a pig?" How many remember that, everybody? Remember, "What's time to a pig?" That joke that Howard said. But the guy lives forever. So here's the beauty of what I do. My material changes every year. My material changes between now and a month from now, all right? And therefore, I always have new material to talk about. So I'm the technical guy on taxes. So what you got to do, everyone, is you got to stay at this level with me and not dive into the trenches, all right? Let your accountant dive into the trenches with this. You are free to give my PowerPoint presentation, which will be on the website, Star Power, as well as last year's PowerPoint. Take them to your accountant and have them look at it. How many of you have done that in the past, everybody, just out of curiosity? And maybe they agree with most of what I say, and maybe they disagree with a little bit what I say, but I'll guarantee you that they will be in agreement with most of what I have to say. Simple as that. And the trouble with accountants right now is they're getting older and they're getting fewer. And if you've got a good accountant, stick with them, everyone, and don't go out and shop the market, because CPA firms all over the country are having a heck of a time bringing new accountants in because they don't want to do the kind of work. How many of you experienced that, just out of curiosity? All right, so get a good accountant and stick with them, no ifs, ands, or buts. And then push them. So you all know my background, so I'm not going to go any further than that. But let me tell you this, all right? Never has there been the time to be involved with RPAC, everyone. Invest in RPAC. Invest in RPAC. Invest in RPAC. All right? This organization within AR has kept the benefits of owning a home intact, everyone. The $250,000 and the $500,000 exclusion when you sell the home. And there's even a big effort to double that to $500,000 for singles and $1 million for marrieds to account for everybody, the Connecticuts and the Massachusetts and the Californias of the world. Although in Illinois, where I live, it doesn't matter one heck of beans. It is $250,000 or $500,000 is most likely plenty. But I'm telling you that you want to be loyal investors, not contributors to this organization. But this organization and NAR helps protect realtors, homeowners, investors' interest in taxation alive. Now, first and foremost, okay, so here we go, everyone, and you're welcome to jump up and ask questions, all right? And I'll be here for a little while afterwards, and I'll be more than happy to talk to you. But you got to have a good accountant, no ifs, ands, or buts. If you are doing your own information, your own taxes, you're making the mistake of the year. You need a good accountant that you meet during the year. Not March 1st, everybody, to discuss what happened in the last year. You've turned your accountant into a reactor instead of a planner. I meet with my clients. I meet with them 4 times a year. And I'm not taking on any new clients, all right? So I'm not here looking for your business, all right? But if my realtor clients and my self-employed clients will not meet with me 4 times a year, they can go find somebody else, all right? Because they've taken my ability to plan for them out of the transaction. So I'm just telling you that I specialize, everybody, in these issues. My job is to keep you informed, and just don't get lost in the technical part of this. Just keep it at the concept level. First of all, show of hands. How many of you are any one of the following entities? Raise your hand as I ask the question. How many of you are an LLC? Please raise your hands. Okay? Anybody look around while I ask these questions. All right? How many of you are an S corporation in this room, which is a favorite entity of mine? How many of you are a C corporation, about a regular corporation? And finally, how many of you are in a partnership? Please raise your hand. Now, everybody that just raised your hands, raise them in unison right now. LLC, S Corp, C Corporation, or in a partnership. Here's the deal. Big Brother is watching. Some of you have already filed this report. How many of you have already filed the report I'm going to talk about now? All right? And not many of you are raising your hands. Big Brother is watching. The federal government is trying to identify all owners of the entities that I've just mentioned who own a 25% or more interest in the entity. And you have to identify yourself on a federal, and everybody don't shoot the messenger here, all right? This is the way it is. This started 1/1 of 24, all right? So I might have mentioned this a year ago in Denver, but it's in effect right now. You have to go on the line, all right, to file the BOI report, the Beneficial Ownership Information Report, and tell the government who you are, where you live, what your address is. You have to upload a copy of your driver's license or your passport, all right? And the theory of this, Big Brother is watching, is that if they catch somebody doing something illegal, all right, bringing money illegally into this country, drugs, from Cuba, whatever the case may be, they have a database of where people are parking that money in their little entities all over the U.S. You get my picture here, buddy? So they'll be able to follow the money. Now, watch this. Look at this. Here's the details. So if you were one of those entities, and by the way, show of hands, how many of you have heard of this before now? Please raise your hands, all right? And a lot of you have, but not all of you have. Effective for entities that were in effect, all those four entities, on 12/31 of 23. You have a 1-year period to file this report via the internet on fincin.gov with the federal government. FinCEN, everybody, stands for Financial Crimes Network. And you literally go in and file this report. It takes about 15 to 20 minutes. And you're done, all right? But if you don't do it, on 1/1/25, the penalties are $500 a day with no limit. So wait a year and fail to do it, everybody. Literally $500 a day times 365 is a lot of money. So you got to do this. Here it is, right? So if you were in existence as an entity on 12/31 of 23, you have a 12-month window to do this right now. But the deadline is 12/31 of 24. Now, if you formed one of those entities after 12/31 of 23, like this year, then you have 90 days to file the report, all right? So everybody get on this. Now, watch this if you would, all right? Now, your accountants are being told by their attorneys not to do this for you, all right? I've told my clients, based on advice from our attorney, I'm not doing this report for my clients, all right? Because our E&O insurance won't cover us. That's the problem, all right? So the big CPA firms wouldn't touch this with a 10-foot pole. So I've told all my clients, look at the overhead. By gosh, get it done now. It's not that difficult. But don't you dare wait until December 15th of 2024 and scream at me because you haven't got the report done. Their crisis is not going to become my crisis. Now, in all my teaching, I've had people actually do the report while I'm teaching. I mean, so somebody will come up at the end of the day and say, I did it, all right? And I say, well, I'm glad you did. So everybody, how many of you are going to get on this in the next 30 days? Please raise your hand, all right? And listen, you don't give up any financial information. You just tell, they want to know who you are, all right? And they don't ask where you bank, all right? They don't ask for bank account numbers. They just want to know who you are. And one more thing. One reason accountants are being told not to touch this, just go with me on this. So you file the report, one and done. Everybody say it, one and done. But then if things change, you got to file a corrected report. Like what? You would change. You would move. All right? You got to file a corrected report. You get a divorce and your last name changes. You got to file a corrected report. And accountants don't want to be on top of that, everybody, because we don't know everything that's going on in your life. Everyone with me on this, all right? So right there, everybody, get it done. And if you go to your attorney, I'm hearing, I was in a conference with a group of them in Minnesota earlier this week. The average fee for a basic report is plus or minus $500, all right? Get her done. I always also say it's tax deductible, all right? So get her done. All right, very good. Now, top 5 maneuvers every one of you needs to consider. And I was just talking to Joyce Shallot class before I came up here, but I am a strong advocate of the S corporation. I have been my entire career. I've been teaching the same subject for a better part of 31 years. How many of you are S corporation, just out of curiosity? And I can't necessarily see the lights everywhere. I can't see your hands because of the lights coming in on me, but I hope a lot of you are. But if you're not an S corporation, then maybe you're a C corporation. Kathy, I saw you raise your hand on that earlier, all right? And that's got its own set of benefits. But the S corporation versus being a sole proprietor, that is the mistake, in my opinion. You can save taxes by making your real estate business into an S corporation. I guarantee it, all right? Now, there are reasons not to do it, everybody. For example, some states, a very few states, all right? In fact, Tennessee, for the longest time, would not let a realtor become an S corporation. Just in the last 5 years, they changed that. And now all my Tennesseans here can be an S corporation if they want to. There's a few states, and I don't know the list of them, that won't let you do this, but the majority of them do, all right? Number 2, I've already said it. You got to have an aggressive CPA or EA, an enrolled agent on your side. The firms that do 80 million returns a year, and I'm not going to mention the big 3, right? They're not what you need, everybody. You need an accountant with a full-time office that is open all year long. Simple as that, right? Third one, and I can tell you that Bob Bolin and I have talked about this, and Brian Jackson and I have talked about this, and Dennis and I have talked about this. Don't do stupid things in the name of taxes. I call that letting the tax tail wag the dog, all right? So I've talked about that heavy vehicle write-off for years. I'm not going to waste your time on it again. It exists, all right? It's still a great deduction. But look at me. I'm 150 pounds, soaking wet. I'm 5'4", and I have to have a stepladder to get into a big SUV, all right? You think I'm laughing, all right? So that's not what I would do. That would be what I would call letting the tax tail wag the dog. First, decide if spending money is good for your business, and then let a good accountant decide the best way to write it off, all right? That's my advice, heartfelt advice. Number 4, know how your business is doing. Every one of you needs to be using programs like QuickBooks or Quicken or any of the other 500 accounting programs out there. But you need to have a monthly profit and loss statement and a cash. I see you shaking your head yes, all right? You need to treat this like a business. And one reason, I see a bunch of you shaking your heads on this, one reason that there's such a failure rate, everyone, in new realtors who get their license is they don't know how to treat it as a business. And the money comes in and the money goes out. There's no accounting for it at the end of the year, until the end of the year. And have a monthly P&L and a cash flow done on your business. Simple as that. And finally, everyone, I'm a big believer in this, and I've been talking to a group of you that we've known each other for years in this room. I'll lay you money, and if we exclude Bolin over here on my left, Bob, that's a compliment. If we exclude Bob Bolin on this, and I will tell you that collectively there are at least 5,000 to 6,000 rental units owned in this room, all right? And everyone, if we take him into account, then we got to up that quite a bit, and that's a compliment. But here's the deal. Look at the last bullet up here. You got to figure out how to make this, whatever this is. You got to figure out how to live on this, all right, whatever this is. And then, by God, you got to invest the difference, all right? And I've been in this organization I go back to Beaver Creek and Vail, everybody. Some of you were back there with us when Howard started this whole thing up. And I've just met realtors in my life, or self-employed people, everyone, that make this and spend this, all right? And at the end of 20 years, they haven't got a pot to you-know-what in, all right? And you don't want to do that. So make this, all right, live on this, and then figure out what to invest the difference in. And I'll tell you right now, my wife, Kay, and I, long ago decided that real estate investments, everybody, were the way to go. Although, anybody with a decent stock portfolio right now cannot be unhappy with the way, look at Nancy, wipe that smile off your face, all right? And everyone, if you don't know what to do with some idle money, put it in Treasury securities. I kid you not. They're over 5%, everybody. They're guaranteed by the federal government. And park the money there for 6 months to a year. But federal securities are a safe bet, all right? So food for thought. Anyway, number 5, keep your expenses in line with your income and then plan what to do to invest the difference. All right, now, it is now coming into August. So we've got 5 or 6 months left. We've got 5 months left. What do we do for the end of the year? This is the time of the year to start thinking how to adjust your taxes for 2024, all right? So before year-end tax moves. So I'm going to go 2 ways. If you're having a really good year financially, and I'm not asking for a show of hands, but if you're having a really good year financially, then what you might want to think about, everybody, is maybe you want to put more money into your 401k for the self-employed, or your IRA, or your SEP IRA. That's a direct dollar-for-dollar tax deferral, all right? You get a deduction for putting the money away, and it saves you taxes. And then you've parked that money away to grow, all right? Now, another thought to that is we all know, or we at least have an idea, that regardless of the politics, which is coming up in a minute, everybody, tax rates are going to go up. I don't care whether we have a Republican president or a Democratic president. Whether you believe this or not, our tax rates in this country have been suppressed for the last 8 years, all right? And they got only one way to go. And we've got this multi-trillion-dollar deficit they've got to account for sooner or later. And in my opinion, we have only one thing to look at, and that's higher tax rates. So, whatever you can do to pay taxes now and to have tax-free income down the road is not a bad thought. So every one of you with a financial advisor, I guarantee you one of the recommendations right now is they want you to first invest in Roth IRAs, number 1. And number 2, they want you to convert some of your IRAs to Roth IRAs. How many of you are being advised to do that, everybody? Please raise your hand, all right? And the theory of that is tax rates are here now, and they're going to be this down the road, whenever that down the road is. So anyway, if you're having a really good year, class, buy real estate investments. And from the heart, hold them. Don't sell them. Anybody with real estate investments, including your principal residence, but especially rental property, whether it be commercial, residential, short-term Airbnb, you've got to be smiling from ear to ear based on the values of those properties today. Your children and grandchildren can't believe the wealth you've amassed, all right, in real estate that they see they'll never be able to do it. That's the look on these kids and grandkids. They'll never be able to do it because they weren't able to get in at really low rates when values were reasonable compared to high rates today and high values. Okay, what else? If you're having a good year, then you've got to consider the aggressive tax maneuvers. Look at the last paragraph, if you would. Faster depreciation, cost recovery, same thing, all right? Section 179, the first year write-off, bonus depreciation. I'm writing a webinar right now for accountants called Everything Real Estate, and that's all about it, all right? But cost segregation studies. People are doing, how many of you have had a cost seg study done on property that you own, all right? Everybody, you talk about lowering your taxes. You pay this for the cost segregation study. Bob, you immediately save this, all right? It's just unbelievable, but remember this. Taxes are generally a matter of timing. What you save today, you pay down the road, all right? Only way to get out of that is die. That was humor, everybody, all right? All right, but that's the only way to beat that game. But what you save now, you pay later. If you don't save now, you save then, all right? So it's a matter of when do you choose to save your money. So 1031 exchanges. I spent 2 hours on the phone arguing with a qualified intermediary in Hawaii yesterday, telling her why a client of mine cannot do a 1031, and I'm telling them they can do a 1031, and we haven't resolved that yet, all right? But there's hundreds of thousands of dollars of tax, and that's Mr. John Riggins, everybody, who a lot of you know out of Hawaii, a CRS member. So that's the friend client that we're talking to the QI about. But let me just tell you this. Politics, all right? They want to either do away with the 1031 exchange or reduce its benefits. Are you with me? All right. And let me tell you what, class, invest in our pack, invest in our pack. Keep those people at bay and leave 1031 away. Let's go the other way. Now look at this, all right? If you're having a weak financial year, all right? So maybe things are not quite as good. And I'll give you some statistics, and this comes from real numbers. Every one of my real estate clients in Champaign-Urbana, Illinois, had their best financial year of their career in 2022, all right? Every one of my real estate clients, and I've got some heavy hitters, had their best financial year in 2022. In 2023, on average, their commission income was down by 40%, all right, versus 2022. And in 2024, they appear to be online or in line with the same 23 results, all right? So everybody, boom, boom, boom. Are you with me? All right. What's the problem, class? High rates, high mortgage rates, low inventory, the same thing plaguing so many markets out there. But you know that better than I do. But if you're having a down year, now this may sound counterintuitive, but it's not. If you're having a down year, then your taxes are lower and you're at lower tax brackets. Now's the time to think about paying taxes, everyone, because your taxes will be at a lower rate. So now's the time to consider converting IRAs to Roth IRAs, because do it while your tax rates are lower, and then hopefully as the income is taken out in later years, the tax rates are higher, but the Roth distributions are tax-free. How many get my message there, class? I mean, I said that accurate. I don't think I said it as clearly as I could, but it sounds counterintuitive to pay taxes when your income is low, but that's the time to get aggressive, everybody, and convert money into Roth IRAs. Pay the tax, pay the tax, pay the tax at low rates, and bet on the fact that it's going to save you more money down the road. All right, it is what it is. Anyway, when your income is lower, and I've got a chart I want to show you in just a minute. If you're having an off year, all right, this is not the time to get aggressive with your deductions. This is not the time to buy the heavy SUV and write the whole darn thing off, all right? If you bought that heavy SUV because you need it, I would recommend you take slow depreciation if your tax rates are lower. And let me show you what I'm talking about, all right? But first, look at this if you would. The problems of having money always outweigh the problems of not having money. Duh, all right? And then look at the right top box. And there's a number of you in this room that agree with me on this. We've had discussions on this over the last 2 days. Everyone, I'm one to tell you that when you have to pay a lot of taxes, you should smile from ear to ear, because you had to make it before you have to pay it. All right? Nobody wants to write that check. But all I want you to think about is smile when you're writing that check. Everybody, I have colleagues that pay no taxes because they do cost segregation studies, all right? They pay no taxes. I know of one out in Arizona, and she was very proud of this. And I mocked her, everyone, because by paying no taxes, I'll show you a chart of this in just a minute, you are getting deductions at your lowest tax rate. And that's not what you want to do, class. You want to pay taxes at your lower tax rates. You want to try not to pay taxes at the highest tax rates. Any CPA in this room, and I know I've got a couple, is smiling ear to ear as I talk about this, everyone. But for those of you that want to pay no taxes, I would not even open my door to you. I don't have time in my life for people that feel that way. It's just not the way to do it. All right. So anyway, there you go. Now, look at this if you would. I'm going to show you a chart. So I get in trouble by telling you to pay taxes, all right? But I'm going to show you a chart. Here is your tax rates. Now, everybody, look at my hands. Stay here with me, all right? The accountant can get into this with you in much more detail. But there is the current tax rate schedule. And I want you to study it for just a minute, because when I get into what candidate Harris would like to do and candidate Trump, I'm going to refer back to this chart, all right? Now, notice the far left-hand corner. These are the actual tax rate schedules for 2024, the return you haven't filed yet. So our rates, the lowest rate individually are 10%. Everybody go down the left-hand column. all the way up to 37%. Everybody agree? And let me tell you what, everybody in this room is all over this chart, right? Trust me on this. Now, then notice the three big columns. My single people in this room, you know who you are. The married people in this room, filing a joint return, you know who you are. And the right-hand column is for my single parents, everyone, with children at home, otherwise known as head of household. All right? And those are the three biggest rates, the three biggest things. And what I don't have here is married filing separately. If I put that up here, class, then everybody gets smaller and you can't see it. Now, study this if you would. Clearly, as you go down the chart, the more you make, the more they take. No ifs, ands, or buts. All right? And then let me just bring up a deduction of $10,000, all right, for whatever, everybody. You want to buy a drone system, you want to buy a computer system, but you're going to spend $10,000. Now, look at the bottom three rates, which are 32, 35, and 37, right? The bottom three down the board. You save taxes at your marginal rate. So if you're at the 37% rate and you spend $10,000 and you're going to deduct it, you just save $3,700, all right? 35%, you save $3,500. 32%, you save that's the way it works. But if you were in the low three rates, 10, 12, and 22, you would only save $1,000, 10%, $1,200, $1,200, and $2,200. Everybody with me on this? So I want you to fixate on the bottom three rates, 10, 12, and 22, and then go across and find the income that's there. Now, the income that's there is after all your deductions, everyone. So you got your GCI minus all your deductions. Everybody with me? And the difference is what I'm going to call profit, all right? And just that profit is find the 10, the 12, the 22. And here's my point. If you find yourself in those rates, then when your accountant Bob, yeah, right, okay, I'm looking at the wrong guy. Right? If your accountant says, we want to be not aggressive on our deductions, that's where the accountant's coming from. How many get my point here, everybody? All right? You don't want to be aggressive with your write-offs when you're at the lowest rates. You want to slow those write-offs out. But by God, if you were my client and you're at the 32, 35, or 37%, then we're going to get aggressive with that $10,000 and write that son of a gun off however we need to. Everybody with me on this? All right. So what I'm trying to say is, yeah, there's a lot of things that are deductible, but maybe you don't want to be writing it all off at one time. All right. I've got a good client of mine. His first name is Joe. And he bought the heavy SUV a couple of years ago as a $70,000 write-off. And here we are on the chart, everybody, all right? And Joe was in the three top brackets. Everyone with me? So that's the time to take the 70 grand. Would you agree? Except his banker told him, listen to me, there are non-tax reasons not to take big write-offs. His banker said, Joe, you're buying 3 rental properties a year. Keep your income up so you can qualify for more loans. Everybody with me on this? Everybody? So guess what, everybody? We did not take the big write-off. We depreciated that 70 grand over 5 years to keep Joe's income up so we qualified for more rentals. Everybody, it's just taxes are a science. All right? They really are a science, and that's why you have a good account. Any questions on what I've just done? Accountants love it, everyone. You want to pay taxes at the 10, 12, 22, and you want to be aggressive when you get to the 32, 35, and 37. Anybody? Any comments? Anyone? Yes, sir. Buddy. Okay, first of all, everybody, so just real quickly, Buddy is going back to the BOI report. Buddy. Oh, yeah, thank you, Buddy. All right. Let me repeat the question. You have to file that report on every entity. All right. So, class, your instructor is an S corporation. 1 report. My wife is a C corporation, Bob. Report number 2. We've got 22 properties split between 5 LLCs. 5 more. Am I clear on this, everybody? All right? So every LLC, the entity files the report, not the owners. The entity files the report and reports the owner's dentist, all right? But if you're controlling that entity, everyone, you're the one that's going to probably be filing that report, or your attorney, something like that. Buddy, great comment. Anybody else? Yes. Very good. Okay, everybody, this is a great question. Let me repeat the question. This young lady's been told that she makes too much money to have a Roth IRA. Everybody give her a hand, all right? All right? Good problem to have, all right? Okay, there are limits on your income in order for you to contribute to a Roth IRA. Everybody say yes, all right? And don't ask me, I'd have to look it up. I can look it up on my phone in 2 minutes. What are the adjusted gross income limits for contributing to a Roth IRA? So here's what you do. The answer to that, class, repeat after me, backdoor Roth. Everybody say it. So what you do is you invest the money, you open a regular IRA, a non-deductible IRA, and 10 minutes later, you convert it to a Roth IRA. So there is an income limit on a contributory Roth. There is no income limit on a rollover Roth. How many of you have employed that device, everybody? Raise your hands, all right? It's as legal as the day. It's called the backdoor Roth. Whoever you use, Fidelity, Vanguard, they know they have the paperwork to do it. All right. The joke is, how long do you have to wait before you convert it? One person will say 10 minutes. Another one will say 2 seconds. All right. It's legal. All right. It's legal. All right. Very good. Now, let me go back to this. Boop, 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 boop. All right. Now, class, here we go. Now, look at the overhead. And this is what I got permission from Amy to talk about. So what are the tax plans? And guess what? I had to change this since last week. All right. I did. But before I go into candidate Harris and candidate Trump, I got to tell you the way it's been for the last 8 years. Are you with me on this, everybody? And please do not get lost in this, all right? When you show this to your accountant, they will go, yeah, I got it. All right? So right off the bat, no politics whatsoever. You're not going to see me boo, ha, ha, either way, everybody. I'm here to present the facts, as I understand it, all right? So look at all the question marks. You know it's going to change, all right? What's going to change, everybody, is A, who's going to be the president, B, who's going to control the House, C, who's going to control the Senate. Are you with me, all right? And those three things are just not known at this time, all right? So there you go. But before I go into what Ms. Harris has to say or Mr. Trump has to say, I want to show you a few slides on the way it's been for the last 8 years. So class, remember I told you taxes are a matter of timing. Everybody now put your hands up like this, timing. So the next slides I'm going to show you is the way we've had a tax law for 8 years, 2018 through 2025. It's called the excuse me, this is the voice from corn tasseling in Illinois in our backyard, so hay fever, all right? But we've had a tax bill called the Tax Cut and Jobs Act of 17 that went into effect starting 1/1 of 18 and ends 12/31 of 25, all right? And everybody watch my hands. In general, that tax bill simplified a lot of tax laws and to a great extent, lowered business taxes. Are you with me on this? So everybody, the first thought is, okay, what happens in 1/1/26? Boom, everybody, those things go away, and then things go up. Everybody with me on this, all right? So that's the general thrust here. So there's that thing. Now, watch this. For businesses, everyone, and I'm getting specific, and some of you are going to roll your eyes, but just stay conceptual. Bonus depreciation has been one of the best write-offs we've had in my career. How much can you write off? All of it. Let me say it again. How much can you write off? Everything. So if a corporation goes and buys a $65 million jet, how much can they write off, everybody? All of it. Right? If you go buy a $80,000 heavy SUV, how much can you write off, everybody? All of it. Right? Well, look what's happened. Right? So notice how this is starting to go down, everybody. It was 100% for a number of years. In 2023, it dropped to 80%. In 2024, it's now down to 60%. So if a corporation goes out and buys a $65,000 Gulfstream, all right, they can only write off right now 60% of the 65 in 1 year, all right? So they want to do away, one party would like to do away with this. Now watch this. Now this list is long, but everything on the next couple of slides has been with us for the last 6 or 7 years and goes away 1/1 of 26. Now, you're welcome to take all the pictures you want, but all of my slides are yours. They will be on Star Power, last year's slides, and this year's slides. But look at this. Reduced federal income tax rates. Right? I've already shown you those, 10 through 37. More favorable alternative minimum tax rules, expanded standard deduction, increased child tax credit. For those of you with children at home, right? If you made under a certain amount of money, everybody, they were throwing money at you for having kids, all right? What I do? Oh, okay, thank you so much, all right? Elimination of the phase-out rule for reduced itemized deduction. You could take charitable contributions for up to 60% of your income. So if you made $400,000 of income, you could literally write off, if you gave it, $240,000 of charitable contributions, all right? So this is the way it's been since 17. What else? Tax-free treatment of student loan forgiven debt. By the way, you see how I have to look at this, everybody? I can't remember all this, all right? Buddy West and I were in a breakout yesterday. Everyone, the federal estate tax exemption. All right, everybody, do this if you would. Do this. Come on, play with me. Everybody, boom. Everybody, one more time. Boom. So I'm serious. All right. So since 2017, they have consistently raised the federal estate tax exemption. All right. And when I lost my father many years ago, class, it was $600,000. All right. Well, this year it's $13,610,000. Last year it was $12 million something. And in 2025 it'll be $14 million. So everybody, come on, one more time. And on 1/1/26 it drops to $6 million. Man, can you imagine the estate planning going on in this country right now with wealthy farmers in Illinois, everybody, who are planning to gift a lot of their assets before this thing does this. Are you with me? So obviously, one party wants to continue this, everybody. Agree? And maybe the other party says, no, we're going to let it drop. I mean, it is what it is, all right? So the humor, and there's no humor in this, but I have sick humor, all right, is the rich need to die. Bob, the rich need to die before 1/1 of 26, all right? And I'll guarantee you this. And that's my sick sense of humor, all right? But the point is, I'll guarantee you, decisions like this will be made, everybody, with wealthy people on their deathbed in December of 25. You think it's happened before, it'll happen again. Bob, that was only humor. Lillian, that was only humor, all right? Anyway, there you go. Okay, very good. Not to kill you there. So here we go, class. So please, no politics here. I'm not taking sides. I'm not going to praise. I'm not going to criticize. Here's my understanding. First, candidate Harris. Everybody with me on this? I suspect that she's going to continue President Biden's policies. I just don't think there's going to be a major push off, at least initially, right? So what would they like to do? What's on their wish list, all right? So the major business provisions, Kathy, they want to, and the reason I'm singling out Kathy Russell about it is because she identified herself as a C corporation. This does not apply to an S corporation, just a C corporation. They would like to raise your tax rate on your profits from 21% to 28%. All right? They're trying to get at the big corporations, everybody, 3M, ADM, Hilton, all this stuff. But when they get to them, they also get to the little C corporation as well. They want to raise the tax rate on corporations. And then there is a tax law, everyone, that if you are invested in S corporations and partnerships that own a lot of real estate or businesses, things like this, if you have a big loss in 1 year, I mean to the tune of hundreds of thousands of dollars, They don't want you to be able to write that all off in 1 year. They want you to write it off more slowly. It's called the excess business loss. Well, they want to make it permanent, everyone. All right? Candidate Harris would like to make that, which is not good for big investors. Now, get specific with me. Look at this if you would. All right? Now we get back to the invest in our pack. Candidate Harris would like to expand the net investment income tax. Now, I know this is technical, but everybody say 4%. 4%. There is a 4% tax. It's actually 3.8% on your net investment income, like on interest and dividends and capital gains. They want to tack an extra 4%, another tax on top of that, and this has been around for years, all right? Well, they want to go after anybody making over $400,000 a year, and that's a lot of you in this room, and they want to make this apply to your S corporation profits. They want to make this apply to your partnership profits, all right? In other words, everybody, you make over $400,000 a year, they want to raise your taxes, all right? Now, you make under $400,000 a year, it wouldn't apply, all right? So it is what it is. Now, what else? Now, this is a carry back to my tax rate schedule earlier. They want to raise the top rate from 37%, everybody, remember the board, up to 39%. Now, watch my hands. But that 37% didn't apply till you got to 600 and some odd thousand bucks. Everybody, look at the board. They want that 39.6 to hit people making $400,000 a year, so they want to raise the rate and lower the income that it's subject to. It is what it is, all right? Now, class, huge. If you are an investor in rental real estate, like you know that I am, capital gains tax rates are one of the most favorable methodologies in tax to save money. All right, the maximum capital gains rate in this country is 20%. All right, the maximum rate on your income from commissions is 37%. Everyone, 20 versus 37. So if you own stocks, bonds, mutual funds, real estate, and you hold it more than 12 months, and then you sell it, the maximum tax rate you will have to pay is how much, everybody? 20% versus 37%. I'm telling you, that's almost half, everybody. That's a favor to investors is all it is. For rental property owners, you're building and owning places that the government doesn't have to build. Are you with me? And there's going to be more of that, everyone, as housing prices are so high. So what do they want to do? They want to tax long-term capital gains and dividends, for example, from sale of real estate, at ordinary income tax rates, everybody, 10 up to 39.6. Right? If you have taxable income above $1 million. Now, if your taxable income is less than $1 million, then you'd still be able to take the 20%. But as a student of tax law for my entire life, let me just tell you this. I'm an ex-IRS agent. Once Congress gets the door open, let's say, and they pass that, and they put $1 million floor on it, everybody watch my hands. Then the next Congress says, let's drop that million to 800,000. And let's drop that 800,000 to 5. How many get my message here, class? I mean, for investors with high income, taxes would go up. This last bullet up here scares me, all right? It really does. All right, next. Any questions, class? And I know this is in the trenches, but I'm trying to stay at a concept level. Anybody? Any comments? Anyone? All right. What else? They want to limit, now I'm still on Candidate Harris's proposals. They want to limit retirement account contributions for high income taxpayers with large balances in their IRAs. Brian and Dennis in their cash balance defined benefit plan. They think that a lot of self-employed people just have too much money put away in their retirement plans. They're going to say, you can't put any more money in, which I think is counterintuitive, but I don't write the laws. What else, everyone? Tighten rules related to the estate tax. Guys, one more time. Boom, all right? They would love to tax more wealthy families. And let me tell you, because I live in central Illinois, where our farmland goes from $16,000 to $20,000 an acre. I know more rich farmers, everybody, worth hundreds of millions of dollars with thousands of acres in their farms that this impacts, all right? Look at the second to the last bullet. Limit 1031 exchanges, everybody. Only 500,000 gain can be deferred in a year. My friend John Riggins, who's not a client of mine, so I can say this, he's got an $800,000 gain, everybody, we're trying to defer with a 1031, all right? If this would hit him, all right, if this law became law, he could defer the first 500 and pay tax on the other 300. Invest in our PAC, invest in our PAC, invest in our PAC, all right? And then look at the last bullet. All of those last couple of slides, all right, all of those things that have been around for 8 years, all right, they want to extend those things for people making under $400,000 a year. So for whatever reason, there's a $400,000 shelf there where I don't know if they're calling that rich or high income or what, but they want people that make under 400 to still benefit by all the old laws, but people above 400 to not benefit by it. And, you know, I'm sure one to say that I want you all above that 400 as opposed to below 400, and it is what it is. All right, what else? Now, there's some child credit issues there as well. Now, an additional point, everybody, and Bob Boland and I were talking about this earlier, but when candidate Harris was a senator, she proposed a basic universal income. And if you don't know about this, you all need to start reading about this, everyone, where states, counties, municipalities have started test programs of a basic universal income, $250 a month, $500 a month to people under a certain level, whatever the case may be. All right? When she was a senator, she proposed this as a $3,000 tax credit, which is $250 a month, all right, for single, $600 for married couples, $500, basic universal income. It never went anywhere, but if she becomes president, everyone, it may surface again. Simple as that, all right? Okay, let's go the other way. Candidate Trump's tax proposals wish list. Now remember, this list is much shorter because remember all that list of all those things for the 8 years, everyone? That was Trump, all right? That was Trump for those 8 years, all those lists of all those things. So this list is short, all right? So Kathy Russell, for your C corporation, he wants to lower your tax rate from 21% to 20%, all right? But that would also impact ADM, Hilton, everybody, and all the big C corporations as well. All right? I don't think it's a misstatement to say that Trump's plans are pro-business and Biden's plans are pro-family. I don't think I'm crossing any line when I say that, and I'm complimenting both of them. All right? But one is pro-business and more is pro-family. What else? Now, here's the other list class, right? He wants to make all those lists of those things for the 8 years, he wants to make them, say it, everybody, permanent. Are you with me? With no income threshold to benefit or disbenefit by. Right? It is what it is. I think the second one is interesting. Consider replacing the income tax with tariffs, everybody. Never happened. That is too big of a change, all right? But I love the third one, and I was going to go around the hotel talking to the waitstaff here about this one, all right? Look at this. Exempt tips from income taxes in 18, look at the data. I didn't know this. IRS W-2 data indicates 6.1 million taxpayers report a total of $38.3 billion in taxable tip income for an average of $6,249 per taxpayer, which I'm sure they don't report, all right? But he wants to make it tax-free. All right. Hey, and finally, so notice my list, everybody, is much shorter for candidate Trump because he wants to extend everything he did for that 8 years. And then it's an election year. What's going to happen this year? Absolutely nothing. All right? Everyone, Congress will be so screwed up with the election, I don't look for any major tax reform, but I'm going to give you a sales job right now. You need to come next year, class, to Salt Lake City, because now we get into specifics of what's going on, because we'll have a new president, would you agree? And now we'll understand the laws, and many of those proposals, I'll bet, are going to take effect in 1/1 of 25. So, Amy, there's my sales job for next year, because I'll be there talking about it there. Very good. All right, now, I was here in Denver last year, and I had been all over the country talking about this list. But I have a list. I put together a list of some of the most significant tax write-offs that will benefit anybody self-employed, all right? And I went into full detail last year with PowerPoint after PowerPoint, and I asked Amy to put that on Star Power. So the list I'm going to show you, the detail is in last year's PowerPoint, and you have available to you. Show this year and last year's to your accountant. They will agree, all right? So anyway, there you are with this, and here's the list, everybody. Here are the 10 most significant things that will lower your taxes, all right? And number 1 is depreciation, the 179 deduction, and bonus depreciation, which I've already kind of reiterated, right? Number 2 is huge. Now, just look at me on this one, class, all right? Since 2018, I've never seen anything like this in my life, so I get red in the face on this. We have been able to write off 20% of our profit as a deduction for nothing. Let me say it again, for nothing. I love to yell as part of the short man Napoleonic complex, all right? That means if you made, don't laugh at me, Dennis, all right? If you made a $100,000 profit in your business, for nothing, you got a $20,000 deduction. If you made $300,000, everyone, 20% of 300 is a $60,000 deduction. How many of you know about this, class? Because I've been talking about it in these rooms for the last 7 years, all right? And guess what? Depending on politics, this either sticks with us or goes away after 2025, all right? I know for a fact I've saved over $30,000 in taxes, 18, 19, 20, 21, 22, 23, and now 24. I've saved over $30,000 in taxes, at least, taxes, because of this 20% deduction. And make sure your accountant is taking this on your rental property profits, because rental property is considered a business. This is a business deduction, Dennis, and a lot of accountants are not familiar with that. So if you own a lot of rental property with positive cash flows showing a profit on Schedule E, make sure your accountant is taking the 20% deduction on your profits from owning rental real estate, as well as your profit from your business of selling real estate. Any questions about that, Cliff? That is clearly one of the most significant write-offs I've ever seen in my life. Yes, sir. Well, okay, Jim. What happens, Jim, is what Jim just asked me, class, is you've got your business here and you got your rentals here, and you get the 20% on this and the 20% on this, and they come to one line on the front page of the 1040, Jim. It's line 12 or 13. But the answer is yes. All right. Okay, next, everybody, number 3, the Augusta rule. And I want everybody to listen to me on this carefully. If you own a second home, this does not apply to your rental property, but if you own a principal residence or a second home, you can rent that out every year under the law, Code Section 280 something. If you rent that out for less than 15 days a year, the rental income is tax-free. All right? Everybody, it comes from the word Augusta, like the every year the Masters. All right? And I have taught for Market House Realty down there, and let me just give you some statistics. 1,100 homes in Augusta, Georgia, go into the rental block every year in April for the Masters, Brian. All right? The average rent for the 8 days of the Masters is $15,000. Right? That is tax-free. Don't look at me so seriously. Smile. All right? That is tax-free income, everyone. And I understand that Tiger Woods, all right, pays $60,000 for the same house every year, class. He's invited for the rest of his life, all right, for him and his girlfriends. And what do I know, all right? And that $60,000 is tax-free every year to the owners of that magnificent house. All right? Now, go with me on this. Now, I get aggressive but legal. For all of you that are either a LLC, like an S corporation, or a partnership, now I offer you to use the Augusta rule, everybody, and this is going on all over the country. Go to TikTok. You'll find what I'm talking about, all right? People that own their own corporation are renting their home to their corporation for quarterly office meetings, photographic shoots. How many of you have heard of this, everybody? Just so you know, I'm not alone on this, all right? And as long as they pay themselves for how many days, everybody? Less than 15, it's tax-free to the owner and deductible by the corporation. All right, everybody. Hey, if this amounts to 10 or 12 or 15,000 bucks a year and saves you $4,000 in taxes, you might as well be aware of it. All right, so you can't do this if you're a sole proprietor. You can only do this if you're an S corp, a C corp, or an partnership. All right, so if you're a sole proprietor, you cannot do it. Next. Cost segregation studies class. If you own a lot of commercial real estate, a lot of residential real estate, rentals of course, all right, and you're paying a huge amount of taxes, take a look at hiring a cost segregation study company to come in, and they will charge you this amount of money to break that building down into its components for depreciation purposes. And you pay this for the study, and you immediately save this amount in taxes. I'm telling you, cost segregation studies are one of the biggest movers in tax write-offs for the owners of commercial and residential rentals in this country. The S corporation class, save yourself self-employment taxes. Save yourself Social Security. The 1031 exchange, already talked about that. The real estate professional status. If you own a lot of rentals, a good way to save taxes, everyone, is the losses coming over from Schedule E of your tax return to offset your income from your sales business. But to be able to do that, you need to qualify as a real estate professional, which means three things. You got to spend more than half of your time in real estate, which obviously all you do. Second, you got to spend more than 750 hours a year. This is all in my PowerPoint last year. And third, you got to manage your own properties. There it is. All right? Or own Bob, the management company that manages your own properties. All right? So it is what it is. Everybody, number 8, stepped up basis. And I know several people in this room have recently lost spouses, so I don't mean anything humorous or blow off here. But the issue of stepped up basis, watch my hands, okay? And I'm doing this very delicately. So your dad bought a rental property for this. Everybody, just watch my hands, all right? Your dad bought a rental property for this. Over his life, he depreciated it down to this. Are you with me? And then he passed on and left it to you, everybody, when it's worth this, all right? It's called stepped up basis. Your basis, your tax basis in that property is the fair market value on the date of your dad's death. All right? So class, he paid this, he wrote it down to this, but it's worth this on his death, and that's $800,000. That becomes your tax basis. So you turn around and sell that for $800,000, tax-free. Tax-free, tax-free. So guys, stepped up basis is just incredible. This applies to married couples, all right? This applies to children inheriting from their parents, right? This applies in community property states and non-community property states, although the rules are a little bit different between the two. But totally serious and not trying to be funny, inheriting property is one of the best tax savings mechanisms that I've ever seen. Simple as that. All right? I have several people. Number 9, just for a second, class, as I start to wrap this up. And Mike, what is my time, just out of curiosity? Mike? You got 5 minutes. Oh, very good. Okay. Number 9. I have several, I'm not going to identify them, but I have several wonderful people in this room, everybody, that back when I was a speaker for Howard Brinton, I started just mentioning the cash balance defined benefit plan. How many of you have heard of this term, class, all right? And it's for my mega earners in this room who are disciplined, all right? Because let me tell you what, if you're not disciplined, then you're not going to want to write the checks to fund these plans, all right? But the typical limit on a defined contribution plan like a 401k or a SEP IRA is around 66 grand. That's the most you can put into one of those plans this year. Right? But in a cash balance defined benefit plan for people making a lot of money, the limit, everybody, is to the tune of hundreds of thousands of dollars a year. So you got to got to have that mental fortitude to write that check. Right? But what you end up with at the end of your career, you end up with $4.5 to $5 to $6 million in your defined benefit plan, versus maybe $1 million or $2 million in your SEP IRA or something like that. And I know for a fact, everybody, that is in existence in this room, all right? And people have done this, and all I did was introduce the concept, and then they went to the specialist to set them up. Everybody with me on this? So, food for thought. It's not for the weak-hearted. It clearly is not for the people not making mega bucks, everybody. You got to be making a lot of money to want to do this. And generally, when somebody comes to me and says, you think I'm a candidate? I go into these questions, how much are you making and how well disciplined are you? And my answer generally, don't do it, all right? Because it does take a lot of fortitude to write those checks. All right, last thing here. The pass-through entity tax loophole. So class, listen to me just for a second on this, and this is a little political. But some of you live in high-tax states, all right? So I got New Jersey, I got New York, I got Massachusetts, I got Illinois. Everybody, I'm from a high-tax state as well, all right? Tennessee ain't. Let me say that again. Tennessee ain't. And you wonder why Illinois loses 200,000 people a year, class, where I live, Illinois, all right, who are moving to lower tax states like Kentucky, Tennessee, Texas, Florida, Carolinas. One of the reasons for that is taxes. All right. So I don't want to make an issue of this, but let me just tell you this. If you live in one of these high tax states, you are paying higher federal taxes because your deduction for a combination of your state income tax and your property taxes on your principal res and second home are limited to $10,000. All right? And let me put this in motion. So Kay and I, class, Illinois has one of the highest property tax rate structures in the country. Our average tax rate is 3 to 4% of value. Multiply 3 to 4% of value. So Kay and I live in a $700,000 house, class, and our tax rate is about $18,000. Are you with me? All right. Then we pay state income taxes of another 15 to 20. Everybody? So there we go. 18 plus 20 is 38. Then we have a second home in Fort Myers, Florida, and that tax is $6,000 down there. So we're up to $44,000 of state income taxes and property taxes, and we're only able to write off how much, class? $10,000. And this has been around since 2018. Okay, so here, listen to me carefully as I end this. If you are a S corporation or a partnership, only those two entities can take advantage of this. One more time. If you are an S corp or a partnership, then everyone, you have your S corporation or partnership pay your state income tax for you, and they get to deduct it, and that is the pass-through entity tax loophole. All right? So who can forget about this? You live in a decent tax rate state. Fine. All right? You're not an S corporation or partnership. Forget it. All right? You got to be an S. Here's the criteria. You got to be an S corp or a partnership, and you got to live in a high tax state. Are you with me on this? And if you don't enjoy those benefits, if that's enjoyment, then forget about this. Hey, in closing, questions, class, comments. Yes, ma'am.
One resource, one book, one website.
Good luck on that. I just no. This I get this every time I teach everybody. What's a good resource to read? One book you can read on everything I've just talked about. There is no such thing. And let me tell you what. I've been asked to write that book so many times. It's got a shelf life of less than a year. All right, that's the problem with what I do. It's got a shelf life of less than a year. So the answer to that, and that's a great question, is have a good accountant that you meet periodically during the year and go with that. Yes, ma'am. I know, and that's why my PowerPoints are for your use. Oh, I'm serious, class. Show them what I've done, all right? And they will agree with most of what I've done. Hey, yes, ma'am, please.
Can you expand briefly on the real estate professional status?
What would you like to know? Can I expand briefly on the real estate professional status? What would you like to know? Well,
Just licensees.
Oh, very good. All right. Well, if you just ask me, you do not have to have a real estate license to be a real estate professional. All right. All you have to do is be more than 50% of your time in real estate, which you do, more than 750 hours a year, which you probably have by April the 1st, and manage your own rentals. How many of you know people, everybody, that are not a realtor that own a bunch of rentals? And that's how they make their money. All right, they are automatically a real estate professional because they meet all three tests. By the way, I'm going to part with this, and I'll be more than happy to meet with any of you after, just whatever your questions are. Don't forget this, everybody. Write this website down, please. EnergyStar.gov. 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 There are fairly significant tax credits for you putting windows, doors, insulation on your principal residences. At least send a flash email out to your clients that there is a new credit that started 1/1 of 23 that's good for 10 years, all right? It's good for 10 years. And the credit limit is $3,200 a year, all right? Now, everybody, that's no big deal, but it's, another way to add value to what you do. Tell your clients to go to EnergyStar.gov and look up the credits that are available for energy savings improvements costs that they put into their home, and in some cases, their principal residence. Part of that, everybody, is solar as well, and solar is the big kahuna. Bob?
Chris, do you know any farmers who have 3 or 4 rental homes who have qualified as professional?
Real estate professionals? The question Bob's asking me, and I'm thinking about this, do I know any of my farm, not clients, but friends, that own a lot of rental properties, everybody? And I've got to say no, all right? I don't know that farmers, if they have money to spend, everybody, they want to buy more land, all right? But no.
Managing the land might qualify.
I'd have to think about that. All right, yes, ma'am. Two in here, and then we'll go. Yes. The question I just got, everyone, and is there a discussion in Washington right now about federal rent control, right? And I will tell you what you're referring to. President Biden in the last month, everybody, has raised the question to make housing more affordable, that should there be some kind of 5% rent control in this country, and invest in our PAC, invest in our PAC, invest in our PAC, because we don't want that. From a landlord standpoint, class, you do not want rent control. Trust me. Yes, ma'am.
I'm planning to transfer some stock out of my escort to some of my sales agents. Is it true that when I do that,
I'll repeat this.
will there be a 1099 that have to be a W-2?
Okay, the question is that this young lady is thinking about, and I like this. Everybody, she's 100% owner of her S corporation, all right? And she is thinking about to retain some good people, about giving them or issuing new stock to these people. So you would still be the controlling owner, but now you'd have different shareholders in the corporation besides you, giving them an ownership stake is what she's doing. And the question she's asking me, and let me just say this, if you are an S corporation owner and you are involved in the business, you must take a salary. I will not listen to anything less than that, class. You must take a salary. Now, how much you have to take is something else, all right? And your question is, if they are now S corporation owners and they are involved, yes, they must take a salary. Yes.
Can they also take a 1099?
Oh, okay, but this is great. We'll talk later on this, all right? But can you have an S corporation owner, everybody, take both a salary and commissions? I see it all the time, yes, right? They take commissions on their sales activity. They take a salary on managing the S corporation. The answer is yes. Everybody, I cannot tell you, I am honored to be here. I will be here, and as long as I can do it, I'm here. Come up and talk to me, and I hope I didn't do this to you, all right? God bless.